Hello and welcome to the Weekend Investing Daily Bite of 23rd of December. So as we roll towards the end of the year, the markets are becoming dull, and I would say that heading towards some sort of cold storage for the next week. It seems the markets did bounce today on the back of the US markets bouncing on Friday evening, but the scale of damage was so high in the last 4 or 5 sessions that today's bounce seems like a drop in the ocean. So it is just a bounce, and that's about it. Have we started a bear market in India is something that we want to discuss in the second half of the video. The idea is to be aware of where things are, and also in our mind, at least in the back of the mind, be prepared for a poor outcome if it comes. We need not predict anything, but at least conditionally, we need to be, our mind needs to be conditioned that in case things go bad from here, uh, we should be prepared for it. So, of course, read the disclaimer and do subscribe to the channel. The percentage of subscribers watching this video is still below 50%. Please take it above 50. My team will get really motivated. Uh, where is the market headed? So you can see here today's candle, although 0.7% up, I mean, no harm in that kind of a jump, but the kind of move that we had on Friday, today's move was sort of uh, a drop in the ocean. Now we will really need to build back, consolidate some base here, and then build it back up. I don't think we are going up in a hurry, and hopefully we may find some sort of a base within this space and not going below the November pivot, because then new floodgates will open downwards if we go there. We are already uh, uh, almost, you can say, into the third month of the down move, and some more months in the down move are always possible. The worst case, of course, is much deeper. Nifty next 50 was not as lucky as Nifty, only 0.27% of gain here at on Nifty Junior. So we are still, I would say, not yet near its bottom. The gap is still open here, and it may continue this journey after a day or two, the way it looks. Mid cap index just about closing at previous day, 0.12%. So nothing to cheer about here as well. After a big crack day on Friday, today was just a relief rally, and that too, only 0.12% on mid caps. Small caps were the worst hit today. Uh, Despite the rest of the market trying to rally, small caps could not rally. So 0.43% down on small caps, and it hit a new December low. It is good to remember that small caps were doing exceedingly well during this phase of the market, and now small caps are uh, leading the sort of market down for now. Bank Nifty, however, was probably the most stable and the best outcome for the day, 1.1% on Bank Nifty, and almost it has covered the previous big down day's move. So in terms of chartically, Bank Nifty looks the strongest amongst all these 4 5 charts. Momentum trends, I would say almost even, so which is not such bad news. 233 advances, 260 declines in the top 500 stocks. Heat map largely green, but then again it is a bounce day, so you can't read too much into these bounces. But significant was that ITC was able to deliver 2%, JSW Steel, Grasim, ONGC, Tech Mahindra, HDFC Bank, Reliance, Trent, all these stocks along with State Bank of India did quite well. There was no major casualty on the day today. In the Nifty next 50 segment, there was more red than Nifty. So you had Zomato lead the Reds down at 2.9%. A lot of insurance companies were disappointed with the outcome of the GST Council, down 2% on ICICI GI, Pruli also down. You had LTIM down, Pidilite down, GSW Energy was down. And real estate again springing back up. So Lodha up 2.8, DLF up 1.63. So any day where the market is green, the first mover these days is real estate stocks, and that gives you an indication where the relative strength of the market is right now. So within the sectoral charts, you will see real estate again pulling the most, 1.5%, still leading on the monthly basis at 6.9%. Banks did well today. Bank Nifty overall up 1.1%. PSU banks also did well at 1.1%. You had FMCG also gain mostly on back of ITC, up 1%, metals up 0.9%. So these were some of the good sort of rallies today. Autos remaining absolutely muted. You can see autos have not participated at all, 5% down for the week. For the month, autos is the worst hit at minus 4.2% after the news of piling inventories. And hopefully next year is going to be good because now the base is low, and on that base next year may start looking good. IT stocks flat, but IT stocks have done decent in the last 1 month. They are the one of the three or four sectors which are in the green, 1.2% on IT in the last 1 month. Pharma has done very well, I think. Pharma, although today it was 0.3% up only, but 2.8% last month. And on 12-month basis, pharma is now the second leading sector in the market at 37.7 behind real estate. And just see where private banks are. Last 12 months, private banks are up 1.4% only, FMCG 1.9% only. So again, this is bringing home the message that unless you will shift sectors, unless your strategies will be dynamic, you will get stuck in sectors which may not move for 6 months, 1 year, 2 years, 3 years, you never know. And even within those sectors, there may be stocks which are, known stocks called the BAP stocks or high quality stocks, and they may miss the best part of a rally because they had run up earlier and they are unable to sustain 90 Ps now. So those kind of things will happen. So you will need to remain agile in terms of your strategy. Real estate stocks, mixed bag actually. Prestige and Mahindra Lifespace is losing some ground, but Phoenix Mill, Raymond's, Lodha, Sobha, Brigade all doing quite well. Overall, real estate remains a buoyant sort of segment in the markets. Stock Spotlight was an Intellect Design, up 19.5% today, very near now again at its previous highs. And this is a very good sign that on dull or flattish days, if some stock is really doing well, it should be in your radar if you are a discretionary trader to look for dips to get into that stock. So let's now talk about the topic of the day. Has a bear market started in India? So while technically a bear market is defined when an index falls, let's say 20% or more, but those are very, I would say, uh, old and orthodox kind of definitions, which in today's volatile markets may or may not hold. I mean, there are so many times that some stocks or some sectors or even some major indices overseas as well has fallen 20% and then come back up. So bear market for me at least is not defined by percentages. Rather, I would think that if the distribution of stocks in the market is looking weak, that probably is defining more that there is a segment which is holding the market up, but then there is a segment which looks like it's in a bear market. It is making lower lows, it is below 200 DMA, and so on and so forth. So we'll try to do some sort of that analysis in today's video. So the headline is that more than half of Nifty 500 stocks are now in a downtrend. I mean, how major is that headline? CNX 500 has lost close to 5% in this last 1 week, and this is the major index that everybody tracks. It's also close to its 200 DMA. So CNX 200 or Nifty 500, sorry, CNX 500 or Nifty 500, whatever you want to call it, has not yet broken the 200 DMA, whereas Nifty has broken the 200 DMA. So large caps have broken the 200 DMA, but the consolidated top 500 stocks index that is yet to break the 200 DMA, although CRX 500 is largely made up of large caps. So from that point of view, the rest of the small allocation that CNX 500 has done reasonably well for the average not to have dipped below the 200 DMA. So overall market trends, 55% of NSE 500 stocks are below the 200-day moving average. So you can assume that if some stock is below 200 DMA, we can say that we are in a sort of a downtrend. Recent 5% decline in Nifty is causing a significant shift compared to October, when only 5% of stocks was below 200 DMA. So while we may be at the similar level to October, but at that point of time, very few stocks were in this downtrend, but now a lot of stocks are in this downtrend. And of 492 stocks with 200 DMA data, 268 are currently trading below this key trend indicator. Now, 92 stocks which are above market cap of 1 lakh crore, 52 are below the 200 DMA. So that is pretty significant. Almost 60% of large companies are trading below 200 DMA, which is not such a good sign, actually, if you say. Notable names including Reliance, State Bank, LIC, Lever, Bajaj Finance, Kotak, Maruti Suzuki, Axis Bank, all these stocks are quoting below the 200 DMAs, signaling slowdown, signaling weakness, signaling a break in the bullishness of the market. Now, the context of last week's sell-off, which was a big sell-off, was that market weakness last week had more pronounced effect than the entire month of October. So if we go back and see the chart of October, so this is where we actually fell. But during this fall, there were not as many stocks that came below the 200 DMA. Whereas in this fall, which looks like a small one, a lot of backs have been broken for many stocks. And sharp sell-off has disrupted long-term trends for significant portions of the market. So if we see this chart, so CNX 500, the percentage of stocks above, let's say, 200 DMA has gone from 60% to 48%. So 58% are below. And if we see a shorter term trend, a 20-day moving average, then we are somewhere near 200 DMA itself, so 47%, 48% on both of them. If we see more numbers, then for 200 DMA, or you can call it SMA also, unless it is exponential, it is EMA, simple moving average is SMA. When we say 200 DMA, it usually refers to the simple moving average. So 42% stocks are above 200 DMA in Nifty 50. Only 36% stocks are above 200 DMA in Nifty Next 50. Only 42% are above in mid cap 150, but 59% stocks are above in small cap 250. So now you know which part of the market is really holding up at least the CNX 500 index. And if we see other moving averages, the same trends are there. 41% of stocks are above 100 DMA, others are only in 20s. And if we see 50 DMA, again you will see 52% small caps are above 52 DMA, and we go even shorter DMA, then 20 DMA, actually no sector, no segment is above 50% of stock. So this is actually showing the breadth of the fall that is happening. Now, if we see sector wise, and please, I would like to stop here for a second. I mean, my team has really done a lot of hard work on this particular data crunching. Do give us a like or a subscribe right now. So if we see the 200 DMA, you will see that IT, pharma, real estate, these are the three sectors where significant stocks are still above the 200 DMA. It is giving you a very clear picture which sectors are leading so far, and where, in case you are a discretionary investor, trader, where you should be looking for setups, and where you should be avoiding, which sectors you should be avoiding right now. Energy should not be in your portfolio. There is zero stocks in energy in your above 200 DMA. PSU banks are only 8%, avoid. Public sector enterprise 10%, avoid. Oil and gas only 26%. So while there may be one or two stocks in these sectors also which are doing really well, maybe on a case to case basis, but on a larger basis, if you see, then these are the only two or three sectors, and it is basically a move towards more defensive, I would say. So IT, pharma, and FMCG typically are the defensive sectors where the market money or liquidity will move when the market is not doing well, and that is almost exactly what is happening. Real estate is a, I would say, an aberration, maybe because of whatever real estate cycle is on in India. But other than that, you can see that, financial services, private banks, infrastructure, commodities, there is nothing above 50% above 200 DMA. And that is a very telling sign. If you see a smaller moving average, again, you will see IT, real estate, and pharma are leading that. Even a 20 DMA is giving you the same picture. So across the board, that is where sort of you really need to focus on. And most of the strategies you would see, rotational kinds, would have moved from these sectors towards these sectors. From the sectors which have low number of stocks above 200 DMA to sectors like pharma, IT, where there are more stocks which are still doing well. I mean, I'm not saying that these are the ones that will multiply or do anything of that sort, but you have to see where the relative strength in the market is and where your money can stay for now. In case these also start falling, then you will basically stay with whichever is the strongest at whatever level it is, or you will go to cash. That is the only sort of measure you can take. But this is a very, very telling picture that don't expect fireworks anytime soon. And this is the time to consolidate. This is time to go back to, in case uh, you are thinking of adding capital, then gradually add capital over this period of time, because now you will get very good sort of, if in case you're doing dollar cost averaging, or if you are just adding two momentum strategies, at least you will go to cash and be ready for whenever that move comes, or you will go into the strongest stocks at this right time. So nothing to really feel disappointed about, because going up and coming down is a natural cycle of the market. To say that market will not come down, or I don't want to participate in the downside, is like fooling yourself. It's like saying that you know I only want to breathe in, but I don't want to breathe out. It will not happen. So accept the market falls, because they are part and parcel of the market, but definitely make sure that you don't get stuck in stocks or sectors that are no longer performing. That is the key to every portfolio doing well, and that is precisely what the problem momentum strategies will alleviate for you. So automatic selection of sectors, automatic allocation, and you really don't have to bother your head whether this stock is going to do well tomorrow or not, whether this sector is going to do well tomorrow or not, because that is the process of the churn that is going to happen, and will keep you with the winners on the way. So this is now the state of the market. Nifty 500 or CNX 500 is exactly at 200 DMA. Let's hope that it holds it and doesn't fall further, doesn't go below this election day high. But if it does, then we are in for some long cold storage. So quick takeaways: exiting markets or stopping your SIPs at this point is probably the worst thing that you can do. So please be patient. If you're new to the market, if you're feeling scared, if you're feeling fearful, allocate only as much as what gives you comfortable night sleep. You should not be getting bothered about this, because this is a plan for your next 5, 10, 15, 20 years. Tomorrow is not going to be any day where you're going to decide whether I'm investing or not. That should not be the case. If that is the case, you should not have been in the market right now anyways. So find out strategies that can identify relatively strong sectors or stocks in weak broad market phases, and that will keep you in the right step in the market. Because otherwise, if you get stuck with stocks which are bleeding, they go down 70-80%, you don't know how to come out of them, when to exit, which to switch into, then you are stuck in a sort of a you can say in a loop, out of which getting out is very difficult. So you need to have dynamism in your strategy, where you have to cut losses, you have to be a little ruthless. You bought something at 100, now it is 70, your strategy is saying get out of it, I'm booking a loss. That's fine, they book a loss, because your capital needs to grow. You need to have that capital allocate to something else that is going to do well. That everybody has limited capital, whether you have 1 lakh in your portfolio or 1,000 crores in your portfolio. The capital is not limitless. So you need to use that capital efficiently, effectively, to make sure that you are able to derive the best ROI for yourself from the market. So this is the message from today's video. Can the Nifty bounce above 200 DMA soon? What is your view about it? Do mention in the comment section. Would love to interact with you there. And do like and subscribe to this channel if you haven't so far. And please share it with your colleagues and family as well. Thank you. Bye-bye.